What's up, everybody? Aaron here with Churchill Mortgage. Wanted to bring you another crazy mortgage market update to keep everybody in the loop on what's been going on with interest rates. What I'm going to do here is play a little clip from Barry Habib. This guy is an expert on mortgage interest rates, the bond market, the mortgage-backed security market, so on and so forth. He's going to talk about what happens when the Fed makes a statement and the drastic impact it can have on rates, which is what we've been seeing lately. Rates have just taken off like a rocket ship. So take a listen to Barry here for a minute.
I know it just makes it difficult for you, but it's important that we're able to explain this, right? This came because yesterday, Lael Brainard, she, along with the Fed Chair Jerome Powell and New York Fed President John Williams, the three most influential members of the Fed, they only have one vote, but they do carry a lot of sway. She said that she looks for the balance sheet to be run off in a very rapid manner. Now, that's going to scare people, because now you start the guessing game. What does rapid mean? $100 billion a month, $80 billion a month? There hopefully will be some equilibrium here. And we pick life in the fast lane because imagine that you have someone driving in the fast lane, the left lane, and they make a mistake, just like the Fed's made the mistake on inflation, and they let it go way too far, and they didn't get off the exit ramp from buying mortgage-backed securities. Because let's remember, was a week ago that they were still buying, not just reinvesting, but buying fresh outright purchases of mortgage-backed securities. Now she's saying in May, she wants a rapid runoff. It's like the person in the left lane who now realizes that they completely blew it, wanted to make the very dangerous move and cut off traffic to get to that exit. Well, this is how accidents happen. And this accident will probably lead to, and we've been convinced of this for a long time because we didn't think the Fed could achieve any kind of a soft landing, would be a recession. We're more convinced of that than ever. In fact, yesterday, Deutsche Bank saying that they see a recession too. And people just keep on jumping to this bandwagon that you've heard from us as back in the fourth quarter of 2021, where we kind of saw this unraveling. Unfortunately, these comments by Lael Brainard causing a lot of disruption. Now, she's one of the most dovish members of the Fed. She, along with other Fed members, completely blew this because they were in the camp that, hey, inflation is going to be transitory, it's going to moderate, and they kept on buying mortgage bonds, just like the person who's looking to go on a diet, but before they do, loading up on gaining weight before they do. It's probably not the best strategy to do so. Now, the Fed's buying about $50 billion now. It was about $70 billion a month in mortgage bonds, and maybe that's settling down now. And here's the thing. If they can do this the right way, not rapidly doing it, I remember when I was taking flying lessons, instructor really harped on me that you do not.
So in a nutshell, what it boils down to is the Federal Reserve has been purchasing mortgage bonds, driving up the price of the bonds, therefore bringing mortgage interest rates down. So they did that through the beginning of COVID. Now that COVID is winding down and inflation is heating up, which again, if you've listened to me for any period of time, inflation is the enemy of interest rates. Now they're saying, look, we don't want to buy these bonds anymore. We've got inflation out there. So the demand for the bond goes down and inflation is going up, making demand for the bonds go down even more, driving up interest rates even further. So in the mortgage business, we've seen rates go up 1.5% to 2% in the last 6 months alone, making it very challenging for homeowners who used to be qualified at 3.5% on a 30-year fixed rate. Now we're looking at the 4 and 5% range. So a big change in what's going on. And the Federal Reserve is doing nothing to help us in this situation, especially given the fact we have got so much inflation out there in the market today. So let's take a screenshot. Let's look at one more thing here real quick. And we'll share my screen. And all right, so let's look right here. So this is a last 6-month look at mortgage bond pricing, mortgage-backed securities. Way up here where my cursor is right here, mortgage bond pricing was high, therefore rates were low. And as you can see, things were starting to sell off in the bond market. So prices were going down, but rates were just inching up a little bit. Then we would see a little bit of a dive here and there. This is a little more of a controlled implosion, so to speak. But as you can see, the green line right here, no control, absolute chaos, bloodbath in the market. So in the end, you've got the bond market throwing a temper tantrum based on what they're hearing from the Federal Reserve. And in addition to inflation driving down their yields, in other words, they can't make as much money. So mortgage bonds just aren't that attractive. So Barry did go on to say that there is a silver lining here. because they have been predicting inflation coming and a recession coming due to the inflation, and that coming recession will cause the inflation to hopefully not go up as fast, maybe get it to recede a little bit. And then when that happens, we're hopefully going to see mortgage interest rates come back down a little bit and be a little more attractive. So I hope that helps. I know it was a little wordy, maybe a little bit technical, but in a nutshell, we just don't have common sense out there when it comes to monetary policy, when it comes to the Fed fighting inflation. Like he said, it was a little bit, too little, too late. And I've been telling people right now, when it comes to interest rates, the old adage, a bird in the hand versus two in the bush. The two in the bush is on fire. So take the bird in the hand, get the interest rate locked in, and just wait until there's an opportunity for you to refinance that at a later date. If you have any questions at all, hit me up, 217-321-2402. Have a great day, everybody. Bye-bye.